This is kind of what the Fed does. It overdrives and has, as we've seen after the financial crisis, after the pandemic, this is what causes permanent distortion between the markets like sucking in that money versus the real economy that doesn't sort of get the same permeation of money. And they did that on the way down with rates, and the way they massively expanded their book with quantitative easing in these two major double doses during those periods, to the point where they have a $9 trillion book at its high. It's just a little bit lower than that. So their book is still sitting around $8.5 trillion, which is massive, which is historical, which is a lot of cushion for basically the markets, and particularly Wall Street banks, who are now about to buy back a ton of their stock, even though they stopped last year. Now, on the flip side, yes, the Fed also had a very aggressive rate hike policy over last year. It spooked the markets. It spook the economy, and there's still going to be an overhang in the economy, even as the markets are going to get comfortable with the fact that the Fed has basically dialed down the size of its rate hikes. You know, we've gone from 75 towards later last year to just 50 basis point hike in December to 25 basis point hike to open up this year. So they're basically going to dribble that down. They're going to go to neutrality. And then after that, I think they're going to turn around, check out the economy, see that the overhang, which Powell spoke about last week, is actually still in the economy, will increase in the economy. And at some point, they're going to turn around. And if they don't cut rates immediately, they're going to start to buy bonds again, or they're definitely, as we've already seen, going to back up from their plan to do quantitative tightening. We're not necessarily going to get a cut in rates this year. And if we do, it's going to be December. It's more likely going to be early 2024. But that's why I do think we're going to see either a major backup from their original intentions of quantitative tightening, or some sort of bond buying. I would not be surprised if, even though they're technically still in quantitative tightening mode throughout this later part of the year, they're still going to potentially buy some bonds here and there. It's going to be very interesting to see where we get on the size of their book. So they have this sort of background thing that they're doing with respect to putting money into the market in a different way. I think that we're going to see that pause probably by June, actually. And the reason for that is not because Powell's not happy, but because Powell has an ego. The data right now, as we've seen it from last week and in numbers going through the beginning of this year, already shows that something called the ECI, the Employment Cost Index, has come down from its increases last year to only increase by 1%. That is not keeping up with the current level of inflation at just over 6%. What that means is, technically, if the Fed wanted to, it could look at the 1% and the 6%, wait till they kind of split the difference, get up to somewhere closer to 4% between those two, and then to 2% and call it a day. I think that's going to take a cycle or two of the FOMC meetings, therefore, to pause rates. But again, a lot of this is tied up in Powell's ego. A lot of it is that he had this posture of this heroic effort to stop inflation, even if it would hurt the economy, which it will, even if it's going to hurt real people, real workers, the real amount that they can buy with the wages that they actually earn versus prices that actually exist. So he still reiterated that at last week's meeting. So he's in this kind of shuffle. So I think we're going to get to neutrality more like June. But either way, we're going to see an ongoing back off of quantitative tightening and potentially more quantitative easing before we see rate cuts. The fact that the Fed even has positioned itself to be able to combat certain kinds of inflation, for example, like fuel and like food, that are part of the contributing factors to the CPI, is a bit ingenuous, because they can't literally impact the cost of gas, for example. If we had another major shock, or an ongoing shock in Europe or between Russia and Ukraine in terms of supply, or something that happens with OPEC, with Saudi Arabia, with China and Saudi Arabia, whatever geopolitically, we could see fuel prices go up, and that's going to take CPI right up, and that's going to take fuel right up, and that's going to make the Fed look like they're not actually able to fight the inflation that they're talking about. So there's a sense of them not just cherry picking numbers, but actually indicating that they somehow have more of an impact than they do on inflation that impacts the pocketbooks of real people, like food, like fuel. The Fed can't do anything, for example, to impact the cost of eggs. The 60% cost of eggs, or basically any items that sort of go into, for example, any family's shopping cart. So there is on both sides a cherry picking of when they want to look at inflation. They didn't care about inflation when housing prices were going crazy, didn't even notice it, haven't noticed it since the financial crisis of 2008, not to mention the acceleration in the pandemic periods, even though we've come down a bit in prices. So yes, they do cherry pick. And that's why I think it's going to take a couple of meetings before Powell sort of is publicly satisfied,
Right.
let's say, with what the Fed's been doing. The whole thing with jobs, which is really sad, is that because the Fed knows, for example, it can't impact the price of eggs or the price of fuel. These are things outside its purview. It's really honed in all throughout the rate hikes on the idea of the labor market being too hot and not acknowledging in this more recent period how the labor market is basically weakening, how we are seeing more layoffs and how we will see more layoffs. And either way, the wage increases have slowed down, and even those didn't keep up with the inflation of the cost of things that people actually need to buy for their homes. And so, yes,
Exactly.
all of this is a distorted reality. And I would imagine, I've probably written this or said this, that if Powell had to live on the average wage of an average American for an average week and buy the things that an average American needs to buy or
Right.
use, he would not be able to do it. I think it was in the more accelerated rise of rates, and it's certainly a place to be parked for people that want the sort of certainty of those higher rates. But I also think there are certain assets, and we've started to see them peak up. Gold, silver, copper, which is being squeezed right now because of mining capacity being taken offline in some places globally and not in other places. There's a lot of investments right now off the bat that are already and will continue to peak up because the Fed has basically entered what I've called stage one of its three-stage pivot. Stage one being they've reduced the size of rate hikes. Stage two will be rate neutrality. Stage three will be when they do start to cut rates, or if we see some QE in the interim. So in this stage one period, this is where other forms of hard assets that have both wealth preservation, some inflationary capacity in terms of combating where it is right now, and also use value in terms of where we need capacity to sort of meet supply. And so I do think there's a lot of activity there, and I'm looking at that also in forms of energy, looking at, for example, further forms of energy like nuclear energy that have sort of come up in conversation more and more, which would require uranium. So there are things right now, asset classes and sectors that really are good investments where the Fed is right now and going forward. One of the things that we saw, and this kind of goes back to the financial crisis of 2008, which is that the world lost confidence in the United States banking system and in the aggressive easing policy at the time of the Federal Reserve. I mean, other countries had to kind of follow it, but certain other ones, like, for example, China, started to kind of have alliances with different other countries in the wake of not necessarily trusting U.S. monetary or banking policy. And this kind of has grown. Right. And in the period from 2008 through the pandemic to now, what's happened is major other central banks around the world that have their own alliances are looking at ways to diversify away from Fed policy, U.S. policy with respect to the dollar and so forth. And this run to gold in particular this period right now where, of course, at first after the pandemic, there was uncertainty. Gold held in very well relative to almost every other currency except for the dollar because the dollar was on a tear up. And I think we've talked about that a little bit here. Right now, the dollar may still stay strong, but in this stage one of the Fed, in this current just demand and thirst for gold to be a diversifier in terms of real sort of traditional hard money away from the Fed and potentially, I'm not saying we would go to a gold standard globally, but as a way to back and strengthen currencies outside of the sort of US dollar purview is why these central banks have been so aggressive at basically buying and hoarding gold.